All right, here we go. Okay, recording now, February 22nd, chapter 11. What is a corporation anyway? You know, it's separate and distinct from its owners. It's we need to say whether it is for profit or not for profit. Typically, people don't say not for profit, they say nonprofit, but it means the same thing. So you may be familiar with some of these corporations. Hope Link would be a nonprofit. Susan B. Komen, fighting against a nonprofit organization against, not against anything, funding for cancer research, for breast cancer research. Still called the Bill and Melinda Gates Foundation, which does all sorts of charity work around the country and around the world. And then here is, you could be a for-profit. So these are all nonprofits. You could be for-profit, which would be all these companies. And then the question is, are you a public corporation, such as Wendy's, Ford, Coke, or Amazon? And we only study public corporations for our projects because we can get the statements for them. And then, or are you privately held, like one of my favorite chocolate companies, M&M, Mars, Snickers. Okay. And that means I can't get their financial statements. Okay, I can look at them if they share them with me. And sometimes there's sources like Hoover's where they gather summary information, but I don't get the detailed annual report. I don't get it's not posted on the SEC website, it's private. All right, so you can see these. So note these, we're going to go through each of these. And again, we're on page 80 of the course pack now. So these are the 3, 4, 5, 6, 7, 8 characteristics of a corporation. Right? And we're going to go through each one. So most of them are advantages. Some of them are disadvantages. Some of them, one of them is both an advantage and could be a disadvantage. Okay. And by the way, I've got the chat open, so if you guys have any questions or anything, just pop it in the chat or interrupt me.
I have a question.
Yeah, go ahead, Michaela.
If a company is private, I know you were saying their financial statements aren't available. Does that also mean their stock is not available to purchase?
That's correct. Now define stock available to purchase. Within the company, they could let you buy into the company, in which case you would be able to buy their stock, but the stock is not publicly traded. Okay. So like for a private company, let's just do this really quick. Let's go. So let's go here and we would say, I can't think of a publicly traded candy company besides M&M, Mars, and they're not public. Let's just say Procter & Gamble. Nope, you're coming up private. General Mills. Here we go, General Mills. That's not exactly candy, but we'll take it. Okay, this is a publicly traded. Can you see this? I'm looking at Yahoo. Okay, so I'm looking at a publicly traded company. Its stock is currently trading at $80.52 a share. Okay. If I look, just for fun, let's look at their 5-year performance in their stock. So they're kind of at a high. If you look back 5 years ago, 5 years ago, they were like $43.74 per share. Okay. And here they go up, up, up. Okay. If I try to go and load the Mars company, it doesn't come up. I can't see the stock. Now, if I were part of the Mars company, or if I were a private investor in the Mars company, they would have to have a different way to value my stock because it's not being publicly traded. But I would with the stockholders' permission, I would be allowed to buy into the company and have a ownership position. So, all right, let's do that. And that's how private companies work. I mean, somebody has to, there are always going to be owners. And so depending on whether they bring more owners in, it's going to be a very similar process, but it's not publicly traded. All right. So let's go through these one by one and talk through them. Separate legal entity. So this, if I personally have stock, a very small, my husband and I have a very small amount of stock in the Starbucks company, and we have a very small amount of stock in T-Mobile, and we have a very small amount of stock in PACCAR. Okay, PACCAR produces Kenworth and Peterbilt trucks, all right? And so our stock that's in our name gives us a little bit of ownership in those companies, okay? But those companies themselves are separate legal entities. Even the word corporation comes from the word corpus, body. And so it's a separate entity. So let's say, for example, T-Mobile went bankrupt and they owed people millions of dollars, millions and millions of dollars. Those people that T-Mobile owes money to, they can't come after me personally. It's a separate legal entity. They can't come after my savings account. They can't come after my house. And it's really important. So that's that limited separation. Okay, there are exceptions to this for the CEO and the CFO positions. Okay, so real quick, CEO, tell me what those terms mean. You can direct message me. What do they mean? Put in the chat. I can't spell very well. So, okay. What do those terms mean? You can direct message me. Oh, there it goes. That's all right. Chief exec, chief financial. Yes, yes, yes. Thank you. All right. Chief executive officer, top position in the company. Chief financial officer, top financial position in the company. All good, all good. All right. So those two positions aren't as protected as the rest of us, but in general, it's the corporation bears its own debt and the corporation bears its own responsibilities. The stockholders are separate from that. Okay. And then here we go. Because of that separation, there's limited liability. Okay. So again, if T-Mobile went bankrupt, if Starbucks went bankrupt, if PACCAR went bankrupt, those companies would have to liquidate their assets and try to pay off all the people that they owe money to. But again, they can't come after the stockholders. Now, if they go bankrupt, the money that I put into the company when I bought the stock, I won't get that back, most likely. That's the extent of my risk, the amount of my personal investment, or I should say our personal investment. So stockholders are at risk only to the extent of their investment. I can make money on my investment. I can lose money on my investment. I can lose it all. The stock can have a zero value. I will have lost all my investment, but I can't lose more than my investment. I can't be responsible. I am not responsible for the corporation's debts. All right, next one, transferable ownership rights. It's super easy to buy and sell stock, particularly for public companies. The company doesn't approve of who can buy and sell the stock for public companies. I just would go and talk to a financial advisor and say, I want to buy 200 shares of Biogen company stock. Biogen does not have to approve it. It's just super easy. For private companies, that's a little different. Usually the partners of the private company have to approve it. So here's me. I call my broker up and they do the trade. Okay. So easy to acquire capital. What does capital mean? In this context. Yeah, I'm really having trouble typing today. What does capital mean? Money. Yes, Hamza, absolutely. So it's money that comes into the company. So we use the term capital all the time in accounting. We say capital equipment. And that, in that case, it means property, plant, and equipment, right? It's in that category. All right. We also say capital is stock. All right. And then when we say acquiring capital, that means there's a capital investment. The stockholder buys stock, the company gets money, and we have more stock. Okay. So it's easy to acquire capital through the stock market. So what does that mean? That means that a company can go out and say, we're going to do an initial public offering. We are going to put ourselves out on the stock market, and the transaction itself is not complicated. There's not, once you've done the initial public offering, it's easy to sell stock. Now, of course, you have to have investors who are interested in your company. And that's a whole nother class in finance, where you have to do something called a prospectus. You have to say, hey, what is the earning potential of my company? What is the product that we have, product or service description? And so you're trying to put this out there and make it attractive to potential stockholders and say, you should buy my stock. We have a great concept. Here's our market prospects. We're the only one in the market with this product or service and so forth. But the transactions are pretty easy. When a company goes public, by the way, they've already been talking to a lot of big investors, some of the banks or some of the institutional retirement account people who are building portfolios. So they're already doing outreach, so that when they hit that IPO day, they already have people that are willing to buy in. All right. It's not just magic. It's a lot of work behind the scenes. I was part of T-Mobile when it was formerly called Western Wireless, and I was there for the initial public offering. And the people who were working on that had been in conversations with banks for a long time, so that they had a lot of investors on that first day when that first opening bell rang in the stock market. Okay, continuous life. So this is continuous life. It keeps going. It's not limited by the life of the stockholders. It's the corporation is formed. If the stockholder dies, it just goes to those shares of stock are part of their estate, and it goes to their inheritors, their children, or their charity. But the corporation lives on and beyond. Okay. All right. Corporate management, both an advantage and a disadvantage. All right. It just is. It's like you're running a company, and we work with a lot of entrepreneurs, really small businesses in the Bellevue, South King County area. And, maybe it's one person with a really good idea, and they're really good at their product, whatever their product is, or their service. Management may or may not be their strength, okay? So they're still running their company because they're small. They're doing their own bookkeeping. They're doing their own marketing. They're doing their own manufacturing or service that they provide. Okay, maybe it's a repair service. Maybe it's a cleaning service. Maybe it's a document handling service, whatever. They're good at it. That's why they started the company. But as they grow, often corporations hire professional managers. They're not owners. They are professional marketers. They're professional accountants. They are professional human resource people. And they bring them in because those jobs are complicated. And as a company grows, you need more and more expertise in those areas. Okay. So that's an advantage. You're bringing in experts. Okay. However, because they are not owners, it can also be a disadvantage. So why would that be? Why would managers who are not owners of a company? Okay. So I want you to think about that question. Why would managers who are not owners of a company be a disadvantage? So you're running a company, you love your product, you're good at it, and then you say, in order to grow, we need to hire some more professional managers. Why would that be a disadvantage? Can you imagine why that would be? Yeah. Yeah, absolutely. Less invested. Okay, help me out. Who is Ofu? I feel like I should know this. Stephen. Oh, yes. Okay, awesome. Thank you. You can change your name, on Zoom. Not that you have to, but limited decision making. There's that too. Yeah. So if somebody is less in, these people are professionals, right? They have skills and talents, and if they're not getting challenged, if they're not getting paid according to what they're providing the company, they're going to leave you and go to another company. Okay. They don't have the same level of investment that an owner has. Okay. Sometimes companies say, well, let's make the managers own stock. As a condition of you being employed here, you must buy stock. How would you guys feel about that? Oh, we want to hire you. We're going to pay you $150,000 a year, but you must buy $10,000 worth of our stock. Would you take a job that had that requirement? $10,000. And so what they're trying to do with this sort of requirement is say, you have to have skin in the game. I don't know if you guys are familiar with that term. Are you guys familiar with that term? Kind of a weird term. In other words, we want to make sure that it's in your interest that the company succeeds. We want you to know, it feels like you're stuck to them now, whatever the experience you have. Beautiful. I love it, Alan. That is perfect. So that sounds so negative, but it sort of sums it up, doesn't it? I gotta write that down. That's a good one. Hang on. Quote of the day, Alan. It feels like you're stuck to them now. You have to endure it. Yeah. And that's not necessarily a bad thing. It's sort of like burning a bridge. The only way out is forward. You can't go back. You can't switch to another company because it's in your best interest to make this company be successful. All right. So interestingly, at some companies, they require the managers to buy stock. And then for the top executives, they loan them money to buy the stock, which to me defeats the whole purpose. But one of those things that you make a rule, it seems like a good rule, and then the people at the top manage to find a loophole about it. Okay, so here's a typical org chart. Here's that CEO position that we talked about, Chief Executive Officer. There's always going to be a board of directors, and they have one job really, and that is to hire the president, CEO. Obviously, they have other jobs. They have meetings. They kind of do a little bit of oversight of the company. And the board of directors position has become a little more complicated in that in around 2000, there were a lot of accounting scandals. And so they said at least one person on the board of directors needs to have accounting experience because they were not catching all of that. And of course, the stockholders elect the chair, the stockholders elect the board of directors. Okay. So if you have a majority position in the stock, that means you get to pick all the board of directors people. Now, this would be the law department. They like to call themselves counsel. This is marketing, this is finance, operations, and human resources. Operations would be like the manufacturing department, the purchasing department. For Starbucks, it would be over the roasting plants. It would be over the stores, over the purchasing, all of that, the core product of a company, okay? The one thing I don't see on this chart that I think is really important is what? Anybody see what's missing at this company? What's missing on this org chart? We need a department of what? Yes, research and development. You're not going to have much future if you don't have research and development. Okay. All right, let's talk about the disadvantages. All right. So there are a lot of government regulations. There are a lot of federal laws. There are a lot of reports that companies have to file, census reports, state laws, and the census reports are different from the ones that we file, that we're involved in individually. They're very specific to the company and the industry. State laws can vary by state. And of course, SEC rules, stock exchange requirements. SEC is separate from the stock exchange, New York Stock Exchange, NASDAQ. I think I spelled that wrong. I think there's a Q, and American Stock Exchange. Okay, so just lots of paperwork. Okay, if you like to do paperwork, you'll be happy working for a corporation because there is a lot. Now, there's a concept called double taxation. All right. Double taxation is real. So imagine this company, they pay out dividends to the stockholders. Okay. So I get a dividend from PACCAR. We get a dividend from PACCAR every year. We have to report that as income and we pay taxes on it in our personal 1040 tax return that we file with the federal government. Okay. However, PACCAR goes down their income statement and they calculate income before tax, and they also pay income tax. So hence the double taxation. Company pays taxes, stockholders pay taxes, all right? So dividends are not deductible for the company. They don't get a tax cut for dividends. They don't get a deduction. Okay. So there was a lot of frustration with dividends being taxable. And there was a big movement about 15 years ago to eliminate dividend taxes, okay? But then somebody did an analysis and determined that the people who get dividends in America are mostly people who are in upper income. So they decided that they didn't need another tax break for rich people. So that bill faded, did not pass. All right, how do we file a corporation? How do we form a corporation? So you file an application with the Secretary of State. The state grants something called a charter. The corporation has to develop bylaws. And for those of you, there's a couple of you that are involved in Associated Student Government here. So it's very similar in many ways. I mean, you're not filing an application, but you're definitely developing a charter and bylaws. And the business leadership community had to do the same thing. We had to write a charter and bylaws. And it really is your guiding principles as well. So oddly enough, most companies don't necessarily incorporate in the place where their corporate headquarters are. Often they incorporate in another state, and that's totally based on favorable tax laws. Okay. So Delaware is a very popular place to incorporate in. They have very good tax laws. All right. So there's a lot of costs associated with incorporation. And so those are called organization expenses. And those costs are just written off. Debit organization expense, credit cash. They're not capitalized as something intangible or anything like that. All right. Okay, so let's go look at your course pack and see where we are. Okay. Okay, so 8 characteristics, and now we're on to page, I guess we're still here. So stockholder rights, I guess. So just use the bottom of page 80 to take the notes for here. Okay. All right. All right. Okay, so stockholder rights. One piece of stock, one share of stock. Remember, we just looked at General Mills stock. I think it was trading at $80 a share. I don't know how many shares General Mills has outstanding. I guess we could take a quick peek. All right, let's see, they have $80 a share. I don't know if it'll say on this page, but let's just look. What the heck? Let's see. I doubt it, but no, they're not going to tell us. Too bad. Okay. No. They have $75,500 worth of stock, but we don't know how many shares that represents. Okay. Okay. So for every share of stock that you have, you get 1 vote. So if you have 2 shares, you get 2 votes, 3 shares, 3 votes. Okay. And we're really talking about common stock. And that's the only stock we've learned so far in this class. Okay. But we'll get on to the other types of stock. All right. So they get to vote on any kind of, we get to vote in the election of the board of directors and on any other action that requires stockholders' approval. So typically, there's an annual meeting every year, and typically that's located, like for the PACCAR annual meeting, that's in the King County. For the Starbucks annual meeting, that's in somewhere in Seattle. And at that meeting, you cast a vote. If you cannot attend the meeting, you can cast a vote by mail or electronically, okay? And you get to share the corporate earnings through dividends, right? So there are 2 ways to make money in the stock market, right? I'm just keying in some concepts here. So there are 2 ways. Dividends is one, and stock appreciation is the other. Buy low, sell high. Okay. And remember, when we looked at General Mills, they had been 5 years ago, they were selling for $45 a share. Now they're selling for $80. So if you had bought the shares at 45, you would make $35 in profit when you sell it. And by the way, that's all taxable. Not your value of what you paid, but the profit that you made. Okay. So there is something called preemptive rights. And as my footnote says, a lot of companies have eliminated the preemptive right, but you can see why you would have it. So if you own 10% of a company and the company decides, we're going to issue more stock. We have 1,000 shares outstanding. We're going to issue another 500 shares. Well, if I own 10% of the stock, I'm going to own 100 shares. Well, if they issue 500 more shares, a preemptive right means they're going to come to me and say, if you want to keep your 10% position, we're going to let you buy 50 shares before we sell it to anybody else. So sometimes that's called the right of first refusal. Okay. So I get to make a choice. I still have to pay money, but I get the choice. So I don't lose my 10% position. Okay. All right. If the company goes bankrupt and the company is just selling off assets and they end up with, I don't know, they end up with $1 million left. And I have a 10% position ownership. I have 100 shares. There's only 1,000 shares outstanding. I'll get 10% of whatever's left over. And that's called a residual claim. So I would get 10% of $1 million, which is $100,000. Okay. But first you pay the lender. You pay anybody in the liabilities. They get their money first. And there's an order to that depending on what type of a loan it is. Okay. And then next the stockholders pay. All right. So if you own stock, you could request a stock certificate. Again, like the bond certificate, most of it is electronic. Okay, we have all the little things here. All right, class of stock. I don't know if you can see that. Class A, name of corporation, Wiley, stockholder's name would be here. Signature of corporate official would be here, and then number of shares. All right. All right. Okay, so I want to do a little bit of practice. So we're gonna look at some journal entries, and then I'm gonna have you guys do a little practice. All right. So here is what the stock. This is the balance sheet. This is not the stockholders' equity statement. This is just the balance sheet. Okay. So the title of this section above here would have been the liabilities section and then the assets section. But right now we're just in that section at the bottom of the balance sheet, stockholders' equity. And you can see paid in capital, and I can't highlight this, and retained earnings. Okay. So there's two major categories on this stockholders' equity account that I want to talk about. There's actually a third category here and a fourth category here, but let's start with paid in capital and retained earnings. Okay. So we've got capital stock, also called, capital stock. And you can see it says preferred stock here, all the way across 600,000. And then it says common stock, and then it's 2 million total capital stock. Then we have something called additional paid in capital. We're going to talk about that in a minute. And so it's additional paid in capital preferred, additional paid in capital common, 30,000, 1,050,000. And then total paid in capital 3680, which is the 2,006,000 plus the 1,080,000. Then we have retained earnings. And then we have total paid in capital and retained earnings. And that's pretty much as far as we've gone up till now. We have not had preferred stock up till now, and we haven't had additional paid in capital. Okay. Now we have something called other comprehensive income. We'll talk about that later in part 2 in the after the exam. And then we have something called treasury stock, which is subtracted. That's why we say less. Okay. So 4730 plus 110 minus 80 is 4760. Okay. All right, here's a corporation. It's got different brands under it. You probably recognize the brand. You probably don't recognize the holding company for all of these. Okay. Lots of brands. And here is, again, here's their balance sheet. Okay. And you've got assets, you've got liabilities and stockholders' equity. And we're really paying attention here down here. Okay. Stockholders' equity. So we're going to blow that up. See how that's the same number, 9739. I just lifted this, I just cut and pasted this down here. Okay. So again, preferred stock, they've got it listed, but they don't have any outstanding. Common stock, there's that term again, additional paid in capital. There's that term again, comprehensive. And then there's retained earnings and total stockholders' equity. Okay. All right. Now here is our stockholders' equity statement. All right. So let's back up one slide. Total stockholders' equity for 2016, 4940921, and the previous year, okay? And do we have a total here? We do not have a total. Well, that's not helpful. Okay. These are shares amounts. You're not going to be able to add these up. Well, that was not a good example. But if you added up 103,3333 minus 104,12545, you would get to this number. And you can see those numbers here. Okay. 103,333. Now, why do we do these stockholders' equity statement separately? Because we want to know what's happening in common stock. We want to know about this category comprehensive, and we want to know what's going on in retained earnings. And remember, the stockholders' equity statement is for 3 years. So if we go down retained earnings, we can see the dividends here for the first year. We can see the dividends here for the second year. We can see the dividends here for the third year. Steadily rising, I might add, 478, 565, and 635. So apparently, outdoor brands, outdoor wear is doing well, okay? Purchase of treasury stock, we can see they bought some treasury stock back every year. And then something else, stock-based compensation, which we'll get to later. Okay. All right, let's do some journal entries real quick, okay? So we have a concept called authorized stock. So in your corporate charter, the company has to decide how many shares they want to authorize. And that is like an arbitrary number. It could be 5 million shares. Okay. It doesn't mean they're sold. It just is the maximum amount that they can ever sell. If they run out of stock, they will have to go back to the stockholders and say, you need to vote on this. We want to increase our authorized shares from 5 million to 10 million or something. And it doesn't mean they've sold them. It's just the number of shares the company would ever be authorized to share without an amendment to their corporate charter. Okay. So when a company goes public, and let's just talk about public companies for now. They can issue money to institutional investors through, investment banking firms, or they can just go out on the stock market, or they can do a combination of both. That initial public offering, they have to set the share, they have to set the price when they go out on the trading floor or when they work with an investor. And these 5 factors are how they set that trading price. And that prospectus that I talked about is their confidence level in what they think their stock is worth. And it's based on these 5 factors. What do we think we're going to make in future earnings? What do we think we're going to pay in dividends? How strong is our balance sheet, our financial position? And then looking at the economy outside the company. Is this a good time to go into the furniture business? The worst time to go into the furniture business would be during a recession, because people do not buy expensive furniture during a recession. They're too busy paying their rent, okay? And then, of course, what's happening in the stock market itself. Ultimately, the market will adjust, but they have to set that initial price. Okay. So it's traded on public organized exchanges. It's and there's constant interaction. I don't know if you've seen pictures of people on trading floors. They're all just literally yelling prices at each other all day long and determining the price once they agree on a contract. Okay. So again, what is published by the company in terms of their earnings and their dividends has a huge impact on the selling price of a stock. So let's take an example. A company's been around for a while. It's the end of the quarter and they publish their quarterly earnings. Immediately, the stock market is going to react. And of course, there are factors beyond the company's control, like COVID, like supply chain shortages, all of that. All right. Okay, so let's take an example. Turn in your course pack. We're going to look at page, it's new share. We're going to look at page We've gone through some of these. We're going to be filling these out as we go. We've looked at the balance sheet and looked at stockholders' equity. And we're on this page right here. So what page is that? 86. Okay. Page 86. And we're about 11:23. So we'll go for a couple more minutes and then we'll take a 5-minute break. Okay. All right. Okay, so I want you guys to answer this question. To take a minute and think about this question. The chocolate company sells 1 share of stock at $30 to Joseph Blow. A year later, Joseph sells it for $40. Joseph makes a $10 profit. Who receives it, the company or Joseph? Who receives it, the company or Joseph? Who gets the profit? Joseph, 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 Joseph. The company doesn't get the $10? I would want them to get the profit. Okay. Okay. Joseph gets the profit. Now, there is a benefit. The company doesn't get anything, Hamza. However, when a company's stock price rises, that's a good thing because it stimulates the market and the company, if they decide to issue more stock, they would definitely be selling at that higher price. Okay. All right. Let's look at the back here. So how much money did the company make? 0. Okay. All right. Okay, this is a review. Okay. So assume, let's see, yeah, I'll give you some room down below. I want you to do number 1A. Okay. And I want you to put that in your course pack. John McLean McLean Company issues 2,000 shares of $1 par value stock. McLean's journal. What is McLean's journal entry for this? How do you issue common stock? So take a minute and fill out your course pack and then direct message me. Yes, thank you. That's correct, Golban. Oops, I keep switching here. Hamza, you are correct. All right. Go back here. So that was a review of, I think, chapter 3. When we issue common stock, we debit cash and we credit common stock. Well, it's actually not that simple, okay? So we have a concept called par value. And years ago, par value determined the legal capital per share that a company must retain in the business. A lot of states today don't require par value. No par stock is quite common, or even more common is like a $1 par value or a 1 penny par value, just something to track the number of shares, okay? And in your homework, if you see stated value, treat it for the calculations the same as par value, okay? All right. So capital has 2 sources. like I said, paid in capital, which could be common stock and preferred stock, and earned capital, which is retained earnings. All right. So we're working with common stock right now. And paid in capital is the amount that the company sold the stock for. And we're going to have two accounts now. We're going to have common stock, and we're going to have an APIC common stock. Additional paid in capital, also called paid in capital in excess of par value. I'm happy to have you abbreviate APIC common stock. Then we're going to go back and we're going to have preferred stock, and we're going to have APIC preferred stock. Okay. All right. So how do we do that? Let's. So you did the first one, 1,000 shares. I hope I didn't. Did I do it? Yeah, here we go. I got it. So we debited cash. This should be in your course pack. We debited cash and we credited common stock. So what happened in this first transaction? We issued the shares. They're not telling us how many McLean had authorized. All right. Maybe they had 10,000 shares authorized, but we've only issued 2,000 shares. McLean has only issued 2,000 shares. Okay. The par value, an arbitrary value, has no relation to market price. The par value is $1. Okay. It just so happens that on the day they sold those shares of stock, the market value was also $1. Okay. So we credit common stock at the number of shares issued times the market price, the selling price. I'm sorry, no. Sorry, par value. We debit cash at the number of shares issued times the market price, which in this example is the same. Okay, but let's look at part B. 1,000 shares are issued for $5 a share. Okay, well, in this case, the cash account is going to be 1,000 shares times 5. Okay, so start out that journal entry in your course pack, and then we'll do a practice couple of these. So I want to see cash at market price, 5,000. Now, common stock can only be credited at par value, that arbitrary value set by the company. So you can see we're out of balance here. All right. And that's when we bring in paid in capital in excess of par value, CS, 4,000. And I don't like this long title. I like to just say APIC, comma, CS, just like I did in the chat. Okay. A lot shorter. Additional paid in capital. Okay. So get these down here. All right. So let's keep going. Sometimes companies, when they're starting out, they have no money. And so they say, we'll pay you in stock. And typically that might be attorney fees or consultant fees or employees. Or they may go to buy assets, and instead of paying cash for the asset, building land equipment, they issue common stock. And so we use the fair market value of the common stock. So if it's in trading, if it's being traded on the stock exchange, we know the value because it's the current market price. Okay. Sometimes if it's not gone public yet, you have to have some experts come in and say, how much stock should we share? But we value the stock at the value of the equipment that we bought. So let's take some examples and then we'll break. Okay, here we go. Assume that attorneys have helped Bruce Company. So again, you guys are writing this in on your course pack on page 86, and this is part B. Okay. All right. Assume attorneys have helped Bruce Company incorporate. They billed the company $25,000 for their services. They're saying, hey, we're worth 25,000. However, they have agreed to accept 24,000 shares of $1 par value common stock. Okay. Bruce Company is not publicly traded, so we have no available market price for the stock. So let's go back to our rules. If we don't have a market price, if we have a market price, we would have said this transaction's valued at 24,000 if that were the market price. But since we don't, we use the fair market value, which is 25,000. All right. And that would be your journal entry. Remember, we don't capitalize organizational costs, we just expense them. So we debit organizational expense, credit common stock, credit additional paid in capital. Why didn't we use 24,000? Because that's not market price. That is par value. We don't know what the market is, so we have to use the fair value of the attorney's fees. Okay. Questions on that? Let's do one more. And assume that Athletic Research is an existing publicly held company. Now we've got a market price. It's actively being traded at $6 a share. The company issues 10,000 shares of stock to acquire land recently advertised at 80. So in the chat, tell me what the value of that land is. So the company gave 10,000 shares of stock to acquire land. How much is the value of the land that was paid for? Yeah, exactly. Yeah, you guys got it. Okay. So this is the journal entry. Why didn't we use the 80,000? Because that's just an advertised price. It's like you going in and saying, I'll pay you 60 for it instead of 80, and then saying yes. So now the value is 60,000, and we have a fair market value price we can work with. All right. Okay, we have gone a little longer. So where is everybody? And I'm going to stop recording. I'm going to